So it's very exciting to have Iain Fulton here today from our Global Equity team. Iain comes all the way from Edinburgh. Iain and his team manage our Global Shares Fund, which comes as both a hedged and unhedged fund. Iain, welcome.
Hi Sam, great to be back in New Zealand.
Yeah. Very good, very good. So here Iain's going to talk today a bit about what's happening in global markets, global economies, inflation, interest rates, and what that actually means for global equity investing. So Iain, first question, how's the last couple of years been?
Yeah, pretty interesting, I think, as ever, Sam. I think it's been, from an economic point of view anyway, it's obviously been quite turbulent. We've had the kind of rise in inflation that's come through after the pandemic. We had incredibly loose monetary and fiscal policy, and that's resulted in, as we all know, an increase in the cost of living and a real bout of inflation all around the world, which central banks have had to fight very aggressively with much higher interest rates. And yet markets, having gone down in 2022, have bounced back incredibly strongly, and economies have actually so far proved to be incredibly resilient.
So can I ask a question then? Say at the start of the year, would you have expected global markets in general, global equity markets in general, to be where they are now?
No. I think the surprise really has been how strong, or how consumers have actually continued to spend in the face of that kind of really high interest rates and those tight policies, and economies have been much more resilient than we expected. And there's probably a couple of reasons for that. I think it's maybe just a lag in the monetary policy. So as interest rates have gone up, normally, we would expect economies to slow, mortgage rates go up, and consumers begin to tighten their budgets and stop spending as aggressively. And that's happening to some extent, but it's really not maybe to the full extent that we would have expected at the start of the year. And, I think that's partly because, now we're a little bit less interest rate sensitive, or there's a longer lag in that policy impact. Number one, in an economy like the UK, for example, there's only 30% of households now have got mortgages. And 10 years ago, that was 40%. So fewer people with mortgages, more savers, and that's, they're less of an impact from rising interest rates. And then also on top of that, today, about just over 90% of people with mortgages are on a fixed rate, and those fixed rates are expiring at different times, but they're still on a significant discount to where the actual interest rates are today. And 10 years ago, over 90% of people were on a floating rate. So I think the impact of that tighter interest rate environment is still to be seen. It doesn't mean that we're not going to see it. And I think we've had a rally in markets, but what we've been doing into that is really increasing the quality within our portfolio to make sure that we're able to withstand what still might be, a little bit of a tricky time ahead.
Right, so with that good backdrop, do you buy into the idea that it is going to be on a global basis, but more in your markets that you look at, say the UK, Europe, US, etc., that we are going to see a soft landing on the back of what is really a record speed of rate hikes?
Yeah, I think we will see an impact. We are seeing an impact. We've already seen growth slow down. And I think it doesn't, in terms of all the indicators that we would look at, credit spreads and underlying health of the economy, it does seem that aside from the wobble that we had in the banking system in March, which was quite contained to kind of private equity issues within the technology sector primarily, aside from that, there's no real systemic concerns as to the nature of the kind of slowdown that we might see. So, broadly speaking, yes, caution in terms of overall pace of growth, but nothing to suggest that there's a calamity around the corner. Potentially famous last words, but I think that's how we would view it right now.
What does that suggest then? If interest rates can move that fast, that high, inflation can be that high without breaking the global economy, does that suggest that there was a lot of excess capacity, or the ability for it not to break something must be saying something about the resilience of the global economy.
Yeah, I think there's resilience. There was excess savings, and we've tapped into that. It's not been plain sailing though. We've seen deterioration in geopolitics. We've seen politics in many countries shift quite hard to the right. We've also seen a significant gap emerge between the haves and the have-nots, and lower income ends of society have really struggled with that inflationary pressure because increase in food costs, fuel costs, cost of living. There's been an increase in wages, yes, but not totally offsetting the impact that they've had and the squeeze they've had on their incomes. But for middle and higher income households who had maybe more savings, are the beneficiaries of this kind of fewer households with mortgages, more of them on fixed interest rates, they've been able to weather that storm much more readily and continue to consume at a pretty high rate, to be honest. So there's varying impacts, I think is probably the best way to put it. The question is, because we know that inflation is now coming down, and that's evident in the statistics today. I think the question for investors and for markets is really where that lands and where we go back to. Are we going back to that long-term post-GFC environment that we saw with very low inflation, very kind of stable sort of low moderate growth environment that was really conducive to equity markets doing very well and certain sectors of the equity market continuing to also do very well? Are we going back to that, or is it going to be very slightly different? Our thinking is that actually inflation in the medium to longer term, well, it's easing now, and that's very helpful. It's likely to be a little bit stickier at a slightly higher level than maybe we've been used to, and that's got implications for how we would value companies and what price we would probably pay for them. So I think moving back to that maybe 2 to 3% inflation rather than 1 to 2 that we've maybe seen historically, because a lot of baby boomers retired from the workforce during the pandemic. Immigration's picking up, but it's not picking up at the pace that we might have seen historically. So labour markets have remained pretty tight, and that's led to wage demands and unionisation and all of those things that imply that inflation might hang around a little bit. Also, when I talked about geopolitics, that slight deterioration or maybe a turning away from China, it's not necessarily deglobalisation, maybe just turning away from China in terms of that relationship between the US and China in particular. That has implications as we re-engineer global supply chains, and companies perhaps carry a little bit more inventory. And if you're carrying a little bit more inventory, you probably want to put prices up to compensate for that to some extent. So there's some structural factors in there, and also the long-term movement away from fossil fuels to another power source and putting in duplicate infrastructure for whether it's automotive and electrification, which is all great for the environment and for emissions, but it's additional cost to do the same thing that we've always done to get from A to B. So there are structural reasons to think that inflation might actually be a little bit higher in the medium to longer term.
Sure, and you touched on it before, but in terms of your investment philosophy of future quality, can you talk us through how you've had to adjust this year in terms of your portfolio? Obviously, there are certain characteristics that a company must have to invest, to be investable within your funds. Can you talk us through those characteristics, and also how you've had to adjust this year, especially with certain companies driving a huge portion of the returns this year?
Yeah, I think it's a fair comment, Sam. The portfolio this year in the first half was up about 10% or so, give or take. And things that really drove that were things like the energy transition that I mentioned. Companies there who do engineering and construction and consulting on those projects, they've performed very well. We've seen good gains in areas like that. Then in the areas of travel, that rebound in consumer travel that we've seen, the US spending on travel now 30% above where it was pre-pandemic. It's been a real boon for some of these companies that we own in the travel industry, like Booking Holdings and things like that. So we've had some things that have done exceptionally well. We've had some challenges in healthcare where that kind of lingering cost, issues from the pandemic, retirement of many nurses and that inflation in wage costs and an excess of inventory and some tools and products that have hurt some of the companies there. So we've had a few headwinds in that area. So the portfolio's had things that have done well, a couple of things that have struggled a little bit. But I think the main thing that obviously has characterised this year to date so far has been those 7 mega cap tech stocks having underperformed dreadfully in 2022. They turned on a sixpence, and in the first half of the year, a portfolio of those 7 stocks only would have been up 66% against the market, the rest of the market that was up about 10. So our portfolio performed in line with the rest of the market, but really struggled when you add in the large impact of those just 7 companies. And the reason I think for that is really twofold. So number one, they cut a lot of cost because they had a bit of a cyclical downturn last year. I mean, those stocks were down anywhere between 40 and 60%, many of them. So they had a big cyclical downturn last year. They cut their workforce in many cases, 20% in Meta Platforms' case. So a real aggressive cost cutting. But then the big story, as we all know now, has been that reallocation of capital expenditure away from kind of money losing, kind of white elephant projects like the metaverse into things like AI and this, large language model, machine learning, and the capital expenditure that's gone into that, following on from Microsoft's purchase of ChatGPT or OpenAI and ChatGPT, and the success that had gaining 200 million users in a matter of months. That represented an existential threat to Alphabet and to Meta Platforms, and they've put a ton of capital expenditure into competing and making sure that they're at the front end of these developments. So we've seen a cutting in cost and a reallocation of capital into the spending on AI, which actually is helping to stabilise return on capital for these companies. Because as they're no longer spending on wasteful projects, they're spending on their core business and reinvesting to actually enhance the core of what they do. And that's allowing them to kind of stabilise returns, and that's good for share prices given the starting valuations that they had. So it's been a real kind of dominant theme within the market. And I think, it does reflect the significance of what's going on. We think that every 15 years, if you look back to the 1950s, every 15 years we've had a new computing platform. So mainframes with IBM as the dominant player there. Mini computers came next through the 60s with digital equipment or DEC as the dominant player in that market. And then we had the kind of PC era through the 80s and 90s, and Intel and Microsoft, they dominated that value chain, and one or two PC manufacturers as well. And then came smartphones, or feature phones and smartphones in that era. And we had, first of all, Nokia and then Apple, dominating that platform. And with each platform, what we've seen is that you've had 10 times the number of devices connected to that platform. So, kind of significant growth, but also that one vertically integrated company, such as IBM or digital equipment or Nokia or Apple, one vertically integrated company in most of these platforms has captured about 85% share of that value chain. And we think now what we're building out is an Internet of Things powered by AI with a large language model enabled data center, which is really the next computing platform. And we're going to have many millions of devices connected to that platform running on that basis. So we're in the kind of initial stages of building out that hardware infrastructure. And similar to the mid-90s when we built out the internet and we built out mobile phone technology for running data, that hardware infrastructure rollout phase is actually, it's incredibly powerful. And I think that's what's being reflected in the market today. And the primary beneficiary of that have been companies like NVIDIA, which we now own in the portfolio. And I think that kind of long-term, medium to long-term, next 3 to 5 years, we'll see that hardware really be rolled out with quite an aggressive capex spend into that area. Now, the applications of it in terms of AI and how we use it, I think is quite uncertain. When we think back to when we built the internet in 1999 and the companies that were doing that, at that point we really didn't know what the applications were going to be. We knew we were putting in mobile data networks, but Mark Zuckerberg was sitting in his university dorm. The people at Google didn't IPO until 2004, so they were still working away in their garage effectively. So the apps come after, and first of all we build the infrastructure, and that's what we think is happening today, and that's why the market is running with this very strong theme, because there's a realization that this is something really substantial.
So would you say, from a basic point of view of AI, and if you're doing an equivalent, is AI the internet infrastructure that was seen in the 90s, and then who's going to be the winners and losers in that? Are you seeing AI as that kind of the next phase, and is that why it's become investable for you now that you're investing in NVIDIA, going, look, you can now see that this isn't a flash in the pan metaverse style company. This is actually something that is going to be taken up on a broad basis.
Yeah, I think that's exactly it. I mean, between those kind of half a dozen companies that are spending aggressively in this area, their combined capex is over $160 billion, and they're maybe spending 10% of that, or a little bit more than that now, but just over 10% of that on AI, and that has scope to increase. And that's maybe a slight difference between 1999, where much of the funding was from telecom companies and they were heavily indebted, and they built up a lot of debt doing that. There was funding through IPOs and so on that financed the internet as we know it today. But this time it's being financed by cash flows which have already been earned, and these companies are highly cash generative with large cash piles, and they're deploying that into this new computing platform. So I think we see, we look for visible cash flows, visible improvements in return on capital. And today the visible cash flows and improvements in return on capital are coming through in that hardware channel, because the capital expenditure is being put in place, and we're building out capacity in data centers. And NVIDIA, to run a large language model for AI, you need to operate in a parallel processing environment using NVIDIA chips essentially today. And that, we think, will allow them to capture 85% of that market, and that gives you a large runway of kind of visible improvements in cash flow and profitability. And there are other kind of players within that chain, if you like. So in terms of connectors and power, the power consumption in these data centers goes up substantially. So companies that sell connectors and electronic kind of cabling and so on actually have a significant opportunity, let alone grid infrastructure and the additional requirements for that. So there are several ways to play that kind of hardware rollout, but that's where we think the visible cash flows and profitability are coming through now, and will continue to come through in the next few years. The implications of the spend and the companies who are developing applications, so at the moment Meta platforms, for example, are serving better digital adverts to their customers, and more focused and targeted advertising. That's great for advertisers. It's kind of okay for us as consumers, but that's the main application. But that, to us, doesn't feel like something radically new. That's a continuation of a market share shift away from traditional media towards online media, which has already been happening for a decade. The new application that will drive millions of devices connected to an AI network, we don't know what they are yet, is the honest answer. So to bet on the application development today, you don't really have the visibility of future cash flow. It's a bit like saying, in 1999, when AOL merged with Time Warner, we were told that we were going to be watching Friends in our living room, and you could click on Phoebe's dress or Joey Tribbiani's jacket and buy it on the spot. That never happened. We ended up with a smartphone. We can navigate our way around cities. We can talk to our friends and family all over the world for no cost if we're connected to Wi-Fi. And we've got the sum of human knowledge in our pocket. So the applications were completely unknown in 1999. So to say today that we know what the applications of AI will actually be, it could be drug discovery, it could be development of new applications in industries that have been underserved by technology and engineering and our shift to new infrastructure for that. So we don't know what the applications will be yet, but we know this backbone and this infrastructure of this next computing platform is being built, and that's where we think we should be investing today.
Fantastic. I think it's a pretty comprehensive answer on AI.
Thanks.
Moving on to another topic, and you can link it back into NVIDIA and other parts of your portfolio. How do you see the challenges of applying ESG or environmental, social, and governance across your portfolio in this changing environment? Because you talked about NVIDIA requiring and AI requiring a lot more energy, which obviously includes power and energy sources. Can you talk me through how you think about that within your portfolio as you implement some of these companies or bring them into your portfolio, whilst at the same time you have in the past been, and you still are, looking at the energy transition? So how does that all tie in for you to make sure that you're on the right side of both ledgers there?
Yeah, I think ESG. Firstly, I think that there's two aspects. There's the risk side of ESG and there's the opportunity. So on the risk side, we would put every company that we invest in through the same level of kind of scrutiny around. We invest in companies that have healthy profitability, strong returns on capital. So quite often that will meet up against regulatory scrutiny or scrutiny from wider society because you're successful. And so the kind of those companies essentially have to behave in the right way to make sure that they earn the right to have those high returns on capital. And that's just an important dynamic of business. And we think the best companies really understand that already, because Apple, for example, they are the dominant player in smartphones, as we know, and they could dominate that supply chain that they have, but they know that they have to leave enough on the table for those suppliers to be profitable and to grow with them in order to kind of keep that healthy and make sure that's sustainable. So we put all of our companies through that level of kind of assessment, and that's how we manage the risk side of ESG, if you like. In terms of the opportunity, we think energy transition and particularly electrification. So yeah, the power consumption of an AI data center goes up a lot. But equally, if we're going to improve emissions in the automotive fleet, we need to electrify. Now, we're not particularly bullish on Tesla. There's, as a car company, we think it's expensive. If it does solve for self-driving vehicles on using AI, maybe that's the killer application. And if it is, then it's probably worth a lot more than it is today. But we'd be speculating as to whether that happens and if regulators actually allow it. But in terms of electrification, because we're very bullish about the adoption of electric vehicles, because there's lots of competition entering that market, prices are going to come down, and that's allowing consumers to adopt the technology. But as we electrify, for example, in the US, we have 270 million parked cars today. We manufacture 17 million cars a year, and a few million of them are electric today. And we're struggling to charge the vehicles that we have in the fleet today. In the UK in the summer, just there, the service stations in the centre of the UK deployed security guards at the charging stations to manage charge rage. But we're short of charging infrastructure. So if we're short of it today, if we're going to get to electrifying 270 million cars over the next 20 years in the US, probably the same again in Europe and the same in Asia, we've got a heck of a long way to go in terms of the investment that's required in the electric grid to allow all this to happen. So companies like Schneider, companies like KBR and even Worley to some extent, who consult on these large projects to their Amphenol, which is a connector and cabling company, these have got great long-term opportunities. So we want to capitalise on that, and we think there's ways to really benefit from that electrification in such that it improves emissions, something that consumers want, politicians want to do it. How we pay for it's an interesting question, but if we're going to get there, then these companies will absolutely benefit on that journey along the way.
Fantastic. And looking forward, the million-dollar question is: after this start to the year, are you reasonably kind of comfortable with where global equity markets in general are kind of priced at the moment, and do you kind of look into the next 12 to 24 months with a slightly rose-tinted lens on, or do you go into it cautiously optimistic? How do you kind of look at going forward? Tough question, but we have to ask it.
Yeah, no, I understand that, and I think I would always, and almost regardless of when you ask me this, I'd probably say I'd be cautiously optimistic.
Yeah.
But I think right now it's particularly important that we are mindful of valuations. So we don't want to overpay. So where we have invested in this area that's doing particularly well, it's in companies that have seen significant upgrades in their earnings and cash flow because of this shift in capital spending that's going on. So we want our businesses that we're investing in to be supported by that improving cash flow, improving return on capital kind of metrics. And that means that we've been actually shifting the portfolio a little bit away from cyclicality. So we sold companies like John Deere, we sold companies like Carlisle companies, which are a commercial kind of roofing company in the US, and we're concerned about the commercial construction cycle, for example. And I think where we've got concerns over areas of the cycle, then we've been selling and we've been increasing our kind of quality, strong balance sheets, high return on capital companies like Synopsys, which is a software design company for the semiconductor industry. So as you're designing these advanced semiconductors, you use Synopsys software. We also bought Netflix, which I'm sure we're all familiar with, but really high quality cash generative business, which is transitioning into an advertising funded model, which we think actually expands the total addressable revenue available for Netflix away from just the core subscriber base. Even if everyone like you and me are probably going to do traded down to the ad supported model, it's actually more revenue in the long run for Netflix from the subscriber and the advertiser, whereas today they only have the subscriber. So quite exciting businesses that we think have got that ability to manage through the cycle, because we are aware that, as we said right at the start, economies are likely to slow, and there's not quite the tailwind that we've maybe had in the past, and we're going to need to have a bit of resilience in the portfolio to cope with that.
Fantastic. Well, it's been very good to have Iain here today here in New Zealand. Iain and the team in Edinburgh are great supporters, coming out to New Zealand and meeting with clients and talking to us about their views and global issues. We very much value your contribution here in New Zealand, and hopefully you've taken some good points out of it too. And I think the key point is that look forward into the future and stay positive.